Well, folks, the Supreme Court has been busy again, this time weighing in on something near and dear to all our hearts: taxes. Yes, the topic that can make even the most exciting dinner party grind to a halt. Specifically, the court upheld a Trump-era tax on overseas investments, a decision that has been met with mixed reactions from various sectors. This decision, delivered with all the pomp and circumstance of a Shakespearean tragedy, but with significantly less iambic pentameter, has left many Americans scratching their heads, wondering what it means for their financial future. This isn't just about some dusty old tax law, though. It's about the broader implications for our economy and personal finances. This ruling could have ripple effects on how the government taxes your hard-earned, or maybe not so hard-earned, no judgment here, money. It could change the landscape of financial planning and investment strategies. Buckle up, because things are about to get financially complex. We're talking about potential changes in tax rates, deductions, and even how we report our income. Now, you might be thinking, John, why should I care about a tax on overseas investments? I can barely afford to invest in a decent pair of noise-canceling headphones. And to that I say, fair point. But here's the thing, this ruling could have broader implications for how the government taxes wealth in general, affecting everything from your savings account to your retirement fund. And let's not forget, tax laws are often a precursor to other economic policies, so this decision might just be the tip of the iceberg. But here's the thing, this ruling could have broader implications for how the government taxes wealth in general. It could set a precedent for future tax policies that might affect us all. So, whether you're a globe-trotting tycoon or just a regular Joe trying to make sense of your 1040, this decision is worth paying attention to. Because when it comes to taxes, what affects one often affects us all. Stay tuned, folks, because the world of taxes is ever evolving, and today's ruling is just one chapter in a very long book. Now, this wasn't some unanimous kumbaya moment from the Supremes, far from it actually. The court was split 7-2, which in Supreme Court terms is about as close as you get to a bar brawl. This kind of division isn't something you see every day. Justice Kavanaugh, writing for the majority, essentially argued that the tax was kosher because it didn't violate a specific part of the Constitution. He emphasized that the tax was within the bounds of what the government could legally impose. On the dissenting side, Justice Thomas, no, not the one who loves talking about pubic hairs on Coke cans, although wouldn't that liven up a Supreme Court opinion, argued that the tax was unconstitutional because it imposed on unrealized gains. He was adamant that this kind of taxation was overreach. Basically, he was saying you shouldn't have to pay taxes on money you haven't actually made yet. It's like being charged interest on a loan you never took out. Which, fair point. It's a perspective that resonates with many who feel overburdened by taxes. This split decision highlights the complexities of the issue. It's not just black and white, it's not a simple case of right or wrong, but rather a nuanced debate about the government's power to tax and the rights of individuals to hold on to their money, especially when that money is floating around in some offshore account. The intricacies of tax law and constitutional interpretation make this a particularly challenging issue. The fact that even the highest court in the land couldn't reach a consensus on this one shows just how thorny this issue really is. It underscores the ongoing debate about the balance between government authority and individual rights. Okay, let's break down this Trump-era tax like we're dissecting a particularly dry fruitcake. You know, the one full of those weird green candied cherries nobody actually likes. It's a bit of a tough nut to crack, but let's give it a go. The tax, enacted in 2017, was designed to generate a cool $238 billion over a decade. That's a hefty sum, aimed at bolstering the national coffers. Essentially, it requires companies to pay a one-time tax on profits they've accumulated overseas. These are profits that have been sitting in foreign accounts, untouched by Uncle Sam. The idea was to discourage companies from stashing profits in tax havens and encourage them to bring that money back to the good old US of A. This repatriation of funds was supposed to stimulate the economy and create jobs. Now, this all sounds well and good in theory. After all, who doesn't love the idea of corporations paying their fair share? It's a concept that resonates with many, especially when we think about fairness and equity. But the devil, as they say, is in the details, or in this case, the tax code. The complexities of the tax code can make even the most straightforward ideas seem convoluted. The problem is that this tax isn't just limited to actual realized profits, It also extends its reach to potential earnings. It also applies to unrealized gains, which are essentially paper profits. These are profits that exist only on paper and haven't been converted into actual cash. That means companies could be taxed on money they haven't actually made yet, which seems a tad unfair, don't you think? This aspect of the tax has sparked considerable debate and controversy. Unrealized gains, real concerns, the implications of the decision.